Hi, this is Vijay Bambani, and I'm back again to talk about an extremely contextual topic, and especially since I had written an article about this a few months ago on equitymaster.com. I had written why I feel crude oil should actually be going to $20 a barrel, but might just wind up going to $80 a barrel. Since a lot of water has flown from under the bridge since then, an update is warranted. One of the primary reasons why I was advocating crude oil would be bullish was because of the Saudi Aramco IPO. We all know that the prime finished product that the Aramco company sells is fossil fuels, that is both natural gas and crude oil. The profitability of Aramco would therefore hinge on whether oil and gas prices were lower or higher. Aramco would obviously aim for higher prices of crude and therefore would try all the tricks in the book to be able to push prices higher. Sure enough, in the run up to the IPO process, you've read in the media and seen on television and websites, etc., as to how the OPEC has been systematically trying to curtail output so as to keep crude oil prices high. This is a very expected and anticipated process, but it is costly. It costs money when you lose market share, when you basically cut output, you're also cutting down the nation's inflows, which is balance of trade. These output cuts are temporary in nature, and once the IPO is over, done and dusted, you will see the Saudis restoring output back again because nobody wants to lose market share here. It's a highly competitive market in the crude export marketplace, and nobody wants to lose market share. So, my guess is the peak of crude, even though it did not reach $80 a barrel, it did go to a little above $60 a barrel. The peak is done and over with. Unless you have an unforeseen circumstance like a geopolitical event, like what happened on 14th of September 2019 on the Upcake and Khorais refining installations by the drone attack. Unless something of that sort happens, I think the peak of crude oil has been reached. As a matter of fact, the Aramco prospectus itself talks about oil demand hitting a peak by year 2035 latest. And they've also listed out the possibility of that peak demand being reached even earlier by 2030. The reasons are not far to find. You have electric vehicles, you have solar power, which are now breathing hard on the heels of fossil fuels as cleaner, more commercially viable, and environmentally free sources of energy. Therefore, when solar power first made its debut, if I'm not mistaken, it was 1980 in Germany, the cost of producing 1 unit of solar power was $30 per unit. Today, the Chinese are promising us that they will be able to produce solar power in large enough quantities at 75 cents per unit, which is a far cry. Now you have a huge competitor to crude itself. The Saudis know it, and therefore they will refuse to cut output once the Aramco IPO is done and dusted, which is another reason why crude oil prices will remain soft. For all you equity investors out there, this is going to be a bonanza because raw material costs of India Incorporated will fall, and crude, as we all know, has a multiplier effect on inflation. So if crude oil prices go higher, your sabji, tarkari, fruits, vegetables, milk, eggs, everything is costlier. And the reverse is also true. So if crude oil prices are going to fall, you're going to have happy days further ahead. Another reason why crude oil prices will not go to 80 but will probably peak out and then remain subdued once the Aramco IPO is done. If you take a look at Asia, The two significant economies here are China and India. As a matter of fact, China and India are the second and third largest consumers of crude oil respectively. Both these nations are showing signs of slowing down. The Chinese because of their trade war with the United States, and in India, we are having a cyclical slowdown to the extent that electricity consumption is now down to a decade low. Diesel sales are also down, which tells you that crude oil consumption from India and China are going to remain subdued, and therefore crude oil prices will remain under pressure. Shift your view towards Europe, and the number one and number two economies in Europe, which is Germany and the United Kingdom, are both slowing down. Germany has been slowing down for 4 months now, and England somewhat the same amount of time. Now, these two economies are going to witness a slowdown in consumption of fossil fuels as well. If you were to go to America, you're basically seeing a marginal slowdown in America itself. Also recollect how I've written an article on equitymaster.com about a phenomena called the US presidential election cycle. 12 to 15 months before a US presidential election, magic begins to unravel in the economy there. Inflation falls, which means crude oil prices are subdued. Employment data suddenly perks up, corporate profitability goes up, inflation goes down, and the US dollar firms up. The US elections this time around are on 3rd November 2020. My guess is the American authorities will do both these things, if not one. A, crude oil prices will be subdued to contain inflation. B, the dollar will be strengthened. You have already seen the US dollar index rising from a recent low of almost 97 to hit 98.30. Now, this is like a seesaw which you see in a garden. You put a heavier kid on one side, the heavier kid lifts the other lighter kid up in the air. So if the dollar is strong, commodity prices are subdued. So at least till November 2020, I expect the US administration to aim for a stronger dollar, which automatically means weaker crude oil prices. The other reason I can tell you about crude oil being subdued is the amount of new supply that's going to come into the market in the immediate future. In Norway, you have an oil field which is run by a company called Sverdrup, which is going to churn out 450,000 barrels of oil per day, which is almost 500,000 barrels. There are a couple of oil fields on the Saudi-Kuwaiti border in no man's land. These are established oil fields, but because of diplomatic impasse, they are not being tapped. The Saudis and the Kuwaitis have reached a diplomatic solution, and an agreement has been signed to commission these oil fields, and they will pump out oil to the extent of 500,000 barrels a day as early as February to March 2020. To add a spoke in the wheel of the Saudi IPO, the Iranians have announced a mega oil discovery. This is expected to cap oil prices and even drag oil prices lower substantially. All in all, I expect crude oil prices to run into selling every time there is a spike upwards. So as far as I'm concerned, crude is a sell on rallies as we speak as of now. So I leave this trade idea open on the table for you. If you do see crude oil prices spiking significantly, I think it makes more sense to sell on rallies than to buy the dips. This is Vijay Bambwani signing off for now till we meet again. Thank you.